We're going to do a very high-level discussion of debt, how debt works, what are some of the definitions. We're going to run through it right now. So let's start with fixed debt versus floating debt. So basically fixed debt is fixed usually for a period of 1, 3, 5, 7 years, and that means your interest rate is fixed. In today's world, let's say interest rate is 7%. The lender will tell you, okay, you're going to pay interest at 7% for 5 years. It's fixed. That's fixed type of debt. Floating says, we're not going to have fixed debt. It's going to be changing depending upon some guide. It could be prime, it could be what's called sober, some criteria that says, okay, the government or the markets are going to have some criteria, and then if that criteria changes, if the prime rate changes, then your interest rate can change on a monthly basis. That is called floating debt. So a lot of borrowers struggled in 2022 and 2023 when interest rates went up by 3%, or call it 300 basis points, and suddenly their debt service rose dramatically, and they did not have enough net operating income to service their debt, and they ended up losing their property or having capital calls. It was not a good situation. So generally, you want fixed type of debt. That is a safer situation when you have an investment. Now, sometimes a lender will allow you, if they don't provide a fixed rate option, you can buy what is called a swap, which means you pay a fee to fix your debt for a period of 1, 3, 5 or years or longer. Now, debt has two components. Debt has an interest rate, let's call it 7%, and sometimes it can be interest only. So a $10 million loan at 7% is $700,000 of interest per year. That's your debt service. But lenders sometimes will want you to amortize the loan. In other words, that your debt service has a component of the interest and a component of a return or payment of your amount borrowed, your principal. So you can have an amortization that is short, 5 or 10 years, medium, 15 or 20 years, or long amortization, 25 or 30 years, or even longer. And so as your amortization goes up, the amount of principal that you pay per month or per year starts off much smaller than if your amortization was 5 or 10 years. And so there is a term called a constant table, which you can see online, that says, okay, if my interest rate is 7% and my amortization is 20 years, then the constant is a percent. Let's say it's 20 years, amortization is 7%. Let's just say the constant is 9%. There, you can just use a rule of thumb that says, okay, I got $10 million of debt times 9%, that's $900,000. That's my debt service. So you can go to a constant table and very quickly identify what your debt service is. We talked about interest only. Now let's talk about recourse. When anyone borrows money, whether it's for your house or in a commercial environment, a commercial real estate environment where you have a piece of commercial real estate, the lender generally would like you to have recourse, which means guarantee. And that means that you as the borrower, if for some reason you cannot pay your debt service, the lender has the right to come after your personal assets. Those usually are not your house, particularly in the state of Texas, they're not your house, but it can be everything else. It could be your car, it could be your bank accounts, it could be your business assets, it could be other personal belongings that you have, whether it would be art or something like that. They can come and get it, sell it, and pay back a loan deficiency. That's called recourse. It's called a guarantee. Generally, borrowers don't want recourse. They don't want to provide a guarantee. They want what is called non-recourse debt. And some lenders will offer non-recourse. Some lenders will say, if you put enough equity in front of it, in other words, if your leverage goes down and therefore your debt service coverages go up, the debt service coverage is your net operating income divided by your debt service. So if you have lots of income that can provide a safety for your debt service, lenders are more likely to have non-recourse or limited recourse. Limited recourse could be 25% of the loan amount might be guaranteed or limited recourse. So that's definition of recourse. Borrowers don't want recourse, lenders do. Now, what are the sources of debt? In commercial real estate, there's generally four sources of debt. There is bank debt, and bank debt sounds like what it is. It's banks. It could be very large national banks. It could be regional banks. It could be community banks. And basically, banks lend money to borrowers at a margin higher than what they're paying the interest on the depositors. One of the advantages of bank lending is that it's flexible. And many times a bank will say, we'll provide you additional loan proceeds under what is called good news lending. Good news lending says, okay, in the shopping center sector, I've got a new tenant who wants to come in, TJ Maxx. TJ Maxx will acquire $2 million of capital to get their store open and running, whether it's soft costs or air conditioning, tenant improvement dollars. And you could go to the lender at a bank and say, hey, I've got good news for you. I've got an executed lease from an investment grade tenant, great tenant, TJ Maxx, and that's great news. And I want you to give me $2 million instead of me going to our investors to ask for the $2 million. I want you to give it to me because the credit quality of your asset will be improved and your debt service coverages will be healthier or increase because we have such a great tenant. And most lenders that are bank lenders will provide good news lending. So it's very flexible. And the other piece of flexibility here is that generally prepayment penalties are low or non-existent. What that means is if it's a 5-year loan, but in year 2 or 3 you want to refinance, you want to pay it off, there's no penalty for doing that. So if you owe $10 million in year 3 and you want to pay it off, you can pay it off without having to pay a 1 or 2 or 3 or 4 or 5% penalty. Okay, let's talk about insurance company. Insurance companies provide great debt for real estate. Generally, it's non-recourse, competitive interest rates. The disadvantage of insurance company debt is it's inflexible. So here, if TJ Maxx wanted to come into the shopping center and we needed $2 million of working capital to bring them in, tenant improvement dollars, soft costs, et cetera, you can't go to the insurance company and say, hey, I need $2 million more. They say, tough luck. Okay, so you've got to have a property that either you have enough working capital set aside for these contingencies, these opportunities, these challenges, or you just don't go insurance company debt. But generally it's non-recourse. Now, CMBS is another source of debt. That's commercial mortgage-backed securities. Basically what happens here is that there's large companies, investment banks usually, like Goldman Sachs or Morgan Stanley, that will pool together 100 loans, plus or minus, and then they'll sell off tranches of these loans depending upon the risk of each tranche to large institutional buyers. That's called commercial mortgage-backed securities. Now, the advantage of CMBS is that generally it's non-recourse. The interest rates are low. The loan to value is high, so you can borrow a lot But to do that, it's very inflexible. You can't sell off pieces. You can't get more money if TJ Maxx comes in. You have certain escrow provisions for taxes, insurance, tenant improvement dollars, for physical parts of the property. You have to escrow a lot of funds. It's very, very rigid. So in exchange for a low interest rate, non-recourse, high LTV, loan to value, you're kind of straitjacketed here. So this is hard stuff to do unless the property is extremely stable. And then finally, you have bridge and debt funds. Bridge and debt funds typically are short term, 1, 2, 3 years. Their interest rates are 3 to 5% higher than interest rates at a bank, insurance, or CMBS. But they'll go very high on loan to value, and they'll give you additional funds as you need them for making improvements to the property. So there's a lot of fees, a 1% fee getting in, and every year there's another 1% fee. When you pay it off, there's another 1% fee, lots of fees. So debt fund investors do very well. Borrowers go with debt funds if they cannot use other sources of debt and they're able to get a great deal on a property, or they have something they want to do with the property in the first year, 2 or 3, that creates opportunity, but it's not a stable asset. That's why you use bridge and debt funds. So to summarize, debt can provide higher returns to investors. We prefer fixed versus floating debt. Sometimes to get fixed debt, you'll have to buy what is called a swap with your lender. Interest only, some investors like interest only at the beginning so you can throw off more cash to your investors or develop a cash reserve. If you have amortization, you're basically paying down your principal so that you're reducing your risk on the asset, on the investment, but you're gonna have a little less cash flow to pay your investors. And again, sometimes you'll see interest only for the first 6 months or a year. Sometimes you'll see interest only for 5 years. Borrowers do not want to guarantee the loan, personally guarantee the loan. They do not want what is called recourse. They want non-recourse. Typically, banks want recourse. Some banks, as you add equity in front of the loan, you put equity in first, so that there is so much cash flow that there's lots of debt service coverage, meaning the ratio of net operating income to debt service is above a threshold. Banks want 1.25, 1.35 times debt service coverage. But if you have so much equity in front of the debt, that coverage could be 1.5, 1.75, 2, 2.53 times. And banks feel comfortable enough that they'll sometimes eliminate the requirement for recourse. And then there are 2 other sources of non-recourse debt. Insurance company, low rates, usually fixed for 5 years, a little easier to work with, little bit more flexible than CMBS. CMBS is the least flexible, but lowest interest rate, highest loan to value. And then finally, you do have flexible debt, bridge debt, and debt funds that are generally shorter term, 1, 2, or 3 years, but you got to pay a lot of interest to use these. Generally in today's world, you're at 10, 11, 12%, particularly in the shopping center sector. With banks, you're at 6 or 7%. Insurance companies, you're probably at 6 to 6.5%. CMBS, you're 6, maybe a little bit below. And again, your LTVs, your loan to values, go up a lot with CMBS debt. So where we operate at Rockstep is fixed. We do amortize. Very rarely do we have long periods of interest only. we look for non-recourse, and we prefer the flexibility of bank debt.